Here we are, folks. Welcome, welcome. Another Tuesday evening. Great to have you on the board tonight. Some new names and some old favourites as well. Great to have you all back. This is going to be an important show, of course, tonight, looking at the latest data from my modelling. But we're going to contextualise it with some broader comments too. Just before I get on with the main show, For those who've not seen it before, this is the setup we use. So everything's running, multi-view, chat, a lot of data and stuff around that I can show. And I think the stream's working okay. I had a couple of issues, but I think we sorted. The doggies, of course, are here. They've haven't been fed yet. So normally I feed them beforehand, but because of the change in the hour, it's too early. So they're going to probably get twitchy towards the end of the show. But never mind. That's part of the part of the fun. So if we hear doggy noises off, you'll know what's happened. And I should also say that there's a vague chance I may have to nip out and get a parcel delivered sometime today. So if it's during the show, I'll pop out and pop back. So don't panic if I disappear briefly. Anyway, I think we're ready to go. Let me take the pre-show off and we will start the show formally. Be back in just a moment. Well, good evening and welcome to this live stream on the 8th of October 2024. Martin North from Digital Finance Analytics here. Great to have you on this evening. And it's just me, so we're going to be talking about the analysis and modeling that we've done. And I think we're getting to the pointy end of the conversation now with regard to households and what pressures they're feeling. And the bottom line is simply this, that if you look at what's really happening on the ground, despite all of the hype from politicians about supporting people and everything else, there are quite a few people who are finding it really difficult to get by at the moment. So we're going to try and unpick that a little bit and also look at where suburbs are and where they aren't being so affected. But before I do that, there's a couple of broader contextual issues I want to touch on. And so the show is going to be in three pieces. The first part will be some broader macroeconomic analysis, just sort of get into it. The second will be then the summary of my analysis. And the third part will then be looking in detail at particular postcodes and households and those sorts of things. So bear that in mind. But as always, before I get started, I'll just remind you that we're not providing specific financial or property or legal advice on the channel here. We do moderate the chat, so please play nice. This is as of the 8th of October, as I just said, if you're watching in replay. If you'd like to get a question to me to make sure I see it, if you use that Walk the World, that'll get into my queue, and that means I don't lose it. The trouble is the chat's very volatile, a lot of comments, and I do encourage that, but it means that some of the questions disappear unless you use that Walk the World. So use that Walk the World. I've also enabled Super Chat, which means that you can get your question to the top of the list or indeed make a contribution to what we do around here. As always, I remind you that we don't do this for profit. We do this because we think this is a really important conversation, and particularly now. So that's why this is important. But I do really appreciate all of the support that I get from the community via Patreon, via the various other support mechanisms, including PayPal, and of course, some Super Chats here. Now, before I start, I think we should look at the latest bond story. So this is actually the story with regard to Canada. And you can see here that in Canada, the 2-year bond has really started ticking up. It's now 3.13. We can also look at the UK situation. The bond's now gone up there above 4.26. In the US, the 2-year bond is at 3.9, so significant rise. And in fact, pretty much wherever you look around the place, bond rates are rising. Now, there's some interesting questions, of course, as to why that might be the case. And if you were thinking that the Australian story might be different, not really. We did have a significant run up to nearly 4%. It's come back a little bit, but it's still quite high. So one of the interesting questions to ask about this is, why is it that bond rates have started to move higher? Well, so far as I can see, there are a couple of factors. The first is that markets were banking on very significant rate cuts from the US, but the data in the US was a lot stronger. I covered this in my weekend show. So the rate of slowing of interest rates perhaps will be quite a lot lower than people were expecting. And I think the bond rates are probably reflecting that. Also, of course, there's a risk question with some of the geopolitical stuff that's going on at the moment. So a flight to quality government bonds are seen as perhaps safer than other types of investments in this particular situation. And I think the story in the Middle East and also in the Far East around Taiwan are both worth thinking about in that context. And of course, there were recent discussions with regards to North Korea and nuclear as well. So there's a bunch of things going on. I think the third factor is that the markets tend to try and over-egg the cake in terms of projections and directions. But it looks to me as though we're going to see bond rates higher for longer. Now, that has a very significant impact, of course, on real households, insofar that fixed rates, mortgage rates, are linked very much to where the bond rates are going. And whilst we saw quite a lot of effort to push fixed rates down, the truth is that, in fact, that's being reversed now. So I wouldn't be surprised to see some further changes in the story here. Now, there's another context which is worth just thinking about here, and that's thanks to Cookie Boy. The RBA came out and basically conceded that they messed up with their $188 billion in cheap loans. They may have gone too far. That's the term funding facility. So the liquidity that swamped the markets really is one reason why home prices went so high. And of course, interest rates were very, very low at that stage. So that's very important to understand. And in fact, of course, the RBA is sitting on losses, about $8 billion, because of the fact that bond rates have moved. But more significantly, modelling by the Australian National University said that the banking and government stimulus combined was way over the top. And so one of the reasons why we are seeing property prices and other asset prices bubbling higher is because we've had this liquidity mismatch. We've had lots of liquidity pumped into the markets. That liquidity has to go somewhere. So not surprising, it's put a rocket under home prices until relatively recently, and also, of course, on other asset prices and bonds and things like that, stock markets as well. Now, stock markets have come back a bit, and the question is, will they correct further? Possibly, but I think they'll be more volatile than a single correction. Now, if you just look ahead at what's happened with regards to lending in Australia, which, of course, is the other source of liquidity. So government stimulus and bonds is one, the other is lending. And if you look at the lending data, you'll see that over the last year, lending for owner-occupiers are up 16.8%, and for investors up 34.2% compared to a year ago. So that's from the ABS. So there's a massive amount of further support for home prices in theory because of this lending boom that's been going on. Governments, of course, don't necessarily want to dial back lending, and certainly the banks want to lend more. But that liquidity has to go somewhere. It tends to stoke house prices. Also worth referring to the fact that owner-occupied first-home buyers saw a 9.2% rise, but it fell last month. And in fact, first-time buyers are being squeezed out because of the lending underwriting standards. If you compare it now with, for example, 2 years ago, the typical borrower can now borrow about 40% less for the same income. And as we'll see later, the banks have been pushing on this and saying, well, we should change the lending criteria to release more. Well, I'm not sure you want to do that. In fact, if you want more information on all of the home lending statistics, I made a show the other day called Home Lending Booms. What have they got to hide? The reason I talked about what they got to hide is because the ABS is now going to publish this quarterly rather than monthly new loan data. And I think that's a problem that we should be tracking that real time, I think. Now, there's another very interesting story here, and that is, of course, if you look slightly a longer period, you can see that international house price to debt income ratios have ballooned out. So in Australia, it's 9.7 compared with 2.8 if you go back a couple of decades, and that's higher than New Zealand's 8.2. It's come back slightly in New Zealand, and in the US 4.9, UK 5, Canada 5.6. So we hold the prize in Australia as the most leveraged set of households in the planet. One of the reasons why the RBA dialed their loan ratios up and interest rates up less than some other central banks. And that's translated into a higher debt to income ratio. Now, this is 184.7. That's actually the previous data point from the RBA. I'll show you the latest one in a second. But you can see there that 184 compared to 175 compared to 97 in the US. And you can see there that, like it or not, the debt-income ratios are very high. This is to disposable income, and that means after-tax income, of course. And the other thing that's gone on is, of course, loan rates have allowed the average loan size to increase. And this is data from IFM showing that upgraders on average more than $700,009, people moving up. The overall average $636,000, and the first-home buyers $540,000. So it dropped back very slightly for the market, but upgraders less so. So people are still highly leveraged, and on a debt-to-income ratio, that's 8.76 times. Now, of course, banks are pushing very hard to try and change the assessment criteria to allow people to borrow more. And APRA, of course, has this extra 3% buffer to interest rates. And, well, a lot of people are arguing that you should be allowed to lend below that. And recently, Shane Elliott from ANZ said you should allow young professional borrowers because they're going to have incomes rising. But the other point, of course, is APRA has reported that the exceptions, so in other words, percentage of new loans that actually are in exceptional lending conditions, in other words, outside normal criteria, has risen. It's now about 5%. That's a real problem too. And it's interesting that Andrew Bragg, for the other side of politics, said he didn't want APRA rules rubbing out the Australian dream of entering the property market. So there is some suspicion that the Conservative side of politics would also put more pressure on APRA or take the power off APRA to actually deal with lending criteria. And, the neoliberal philosophy is let the markets be the markets and don't intervene. Well, I would argue that we're seeing the consequences of that. And if you go back to what I said earlier on with the RBA and the TFF, well, they massively intervened. So to my mind, it should be true for all, not just some. Now, if you go forward and just listen to what the media is talking about, well, they're certainly saying that some households are in difficulty. Foregoing food to pay the mortgage, as Finder reported. Food, a pain in the pocket. Grocery costs are the highest pain point. In some cases, they're up 33% in just 6 months, the report said. Petrol prices may be down, but probably going to go up, particularly because of the issues there. And of course, the rentals have surged up to 30% in a year in some areas. Some Sydney landlords are asking by 30% higher. And some renters are relocating to the country for affordability. And the whole point there is this is a real difficulty. If you look at Coleroy and Wiley Park, free houses and units. Roseland's up 31%. Oil prices, well, rising now higher, but iron ore prices perhaps not so much. And there are a few issues there to think about in terms of the pressures on households ahead. It's worth, I think, also just reflecting on this. This was an article that came out the other day saying, well, of course, older Australians, they could actually rent out their spare rooms to help the housing crisis. Well, are you really going to bear down on people to say, well, you've got to lend out your room, or are you going to give them more tax breaks to do it? They're arguing that there's 3 million spare rooms, which could basically solve the housing crisis. Well, I'm not sure it's that simple. And again, I have this problem about, telling people what to do. I should. Now, of course, the fact of the matter is that in some places now we are seeing prices beginning to ease. If rates do get cut, then that could all reverse. And there were some articles that we covered the other day. Rate drop could mean swift price rises. And, there's a lot of talk about that in all the media about, well, when rate cuts, prices will go up. I think it's much less simple than that, not least because, of course, if you look at the latest clearance rates, auction clearance rates are down. And Tim Lawless is saying the high demand stock, the high levels of demand on stock alongside demand side constraints like lower borrowing capacity, low sentiment and affordability challenges like the clearance rates will continue to fade. So the fact of the matter is we are going to see the markets, I think, easing and wobbling despite perhaps some of the intent from builders to try and stimulate demand or banks to do that as well. And I will just make the point, of course, that the real issue here is productivity, and the fact that productivity is not something that the government here wants to really address. They should address. There was a report that said lackluster productivity growth could prolong high inflation and trigger a sharp downturn in economic growth, and particularly in Australia. And the latest intergenerational report forecasts annual average economic growth at 2.2% over the next 40 years, which will be the lowest since World War II. Productivity growth is a real issue. And then, of course, the IMF bailed in and said, well, actually, there should be perhaps a change in tax policy and those sorts of things. The IMF basically said, well, maybe Chalmers' moves were supporting higher inflation. Chalmers, on the other hand, said Labour's running a responsible economic policy and supporting households. So who's right? Who knows? I actually made a show called Who's Telling Porkies Now? And you can look at that show because there's a lot going on. And as I covered with Edwin yesterday, of course, there's shrinkflation everywhere. So now Albo's picking on shrinkflation as something to focus on. That's called misdirection. Look over here, not over there. He announces a crackdown. CoreLogic actually also made the point that in buyers' markets, there's markets where nobody wants to buy, 65 markets in Sydney and Melbourne where values are below record highs from the 2010s, and vendors are even willing to sell there's a loss, but buyers aren't interested. And that was picked up in the Financial Review, citing Epping, for example, where values have plunged 18.4% from May 2017. Got a lot of television coverage too, with Epping, Beecroft, Olympic Park, Granville and Marylands also all showing significant falls. So now people are talking about the price falls, and that's a bit of a change in the weather. So when the media is starting to talk about price falls, you can bet your bottom dollar that prices are moving down in some areas. So it's not universally true, but I think it's an important context. Now, let's now look at the data that I'm going to share with you, specifically around the core market model. And just to remind you that the core market model is the way that I do my analysis. So I run my rolling surveys, 52,000 households at any one time. And we then can take that information and slice it and dice it all sorts of different ways to look at households in particular areas, suburbs, different types of households and all those things. And also form a view of where things may be going, looking at the scenario. Scenarios are not necessarily a specific estimate, just a little bit of sensitivity, but we take stress, the price trajectory, the buying and selling intentions, the migration data, economic and CPI data, put it into the core market model, run the scenarios, and we can look at postcode, region, state, and all Australia levels, and form a view as where prices may run ahead. Oh, and let me just mention again, we do provide our one-to-one service. This is where we can talk specifically to a suburb or postcode. And we're having quite a lot of individual conversations at the moment. People are quite confused about what's going on. So if you want to join the queue there, I can't give financial advice data, but I can talk about the data from my analysis and surveys. I can look at the stress, the home price trend data, and look at price trends ahead of, and look at the modeling and how that plays out. Scenario conversation by Zoom or phone. If you'd like more information, feel free to reach for me. There is a cost involved because there's a lot of research done. You get a 30-page report or so. And we're booking 3 to 5 weeks ahead. Go to my blog if you're interested at the moment. Now, on the stress front, just remind you, I use my cash flow definition, money in, money out. There's lots of other definitions, third spend of income, or even taxable income, or underwriting metrics. But I look at cash flow, money in, money out. So if there's more outgoing, is it something one-off discretionary? Then income, we define them as stressed. If they have a mortgage, they're in mortgage stress. If renting, then rental stress. Investors we also look at in terms of cash flow pressures as well. And also we can look at it at a total financial stress level for a postcode. And we express each as a percentage of households and accounts. The latter's a better measure in my view because it's the law of big numbers, but we perhaps will touch that today, the percentages too. Now, on the definition of stress, the spectrum from the RBA makes the point that people can get into difficulty quite early through budget pressures, miles in financial stress, then perhaps miss payments, and then ultimately go insolvent and may actually default. Now, a lot of the focus on the industry is over in the insolvency end of the metric, where it's still relatively low, although rising. but I'm at the mild end, looking at the early stage of difficulty. So with that introduction, let me share with you the stress data for September. And we'll look first at the overall measure of rental stress, because that's the record 77.26% of households in the rental sector struggling now with their payments. So having to prioritize rental payments over other things, potentially late payments as well are in there. If you then look at the next one, mortgage stress is at 50.1%, so it's slightly higher than last month. And while I'm talking about overall trends, the RBA published the most recent data and now shows that the income to debt ratio is at 186.1, up again. And you can see the upward trend in recent times. So people are highly leveraged. If you go back to the early 2000s, you can see there that the leverage ratio was a lot lower. Here is the latest by state. And as always, I focus partly on the percentages. The percentages, of course, are the proportion of borrowers in mortgage stress, renters in rental stress, investors in investor stress, and financial stress overall. In yellow, it's higher than last month. In blue, it's lower than last month. So you can see there, the mortgage stress, 42% of people in the ACT have mortgage stress, that's 31,000. 80% in rental stress, that's 11,000. Overall financial stress at all households, 88,000 or 49%. In New South Wales, it went down slightly, but still 49% in mortgage stress and overall financial stress at 50%. So more than half of households across New South Wales have cash flow pressures. In the NT, it went up, other than mortgage stress. In Queensland, it went up. We've now got 46% in financial stress, but mortgage stress went down very slightly, rental stress went up, and investor stress went up. In South Australia, same scenario, slightly lower mortgage stress. Now, that is very much to do with the higher tax breaks that people got, and also the government support, particularly electricity and other things. Rental stress, not so much, it's higher. And you can see there that in Queensland, 75% of households are in rental stress, 46% in financial stress overall. In South Australia, 43%. In Tasmania, mortgage stress went up, 57%, went down in the other categories. In Victoria, it went up, 53%. That's more than 514,000 households in Victoria in mortgage stress, and 47% overall in financial stress. In Western Australia, it went up across the board, 54% in mortgage stress, that's 232,000, 75% in rental stress, 218,000, and financial stress, 499,000, 49%. And that takes us to 50.11% in mortgage stress, 77% in rental stress, 16% in investor stress, and 48.17% in financial stress. And in round numbers, that means we have 1.8 million mortgage households with cash flow pressures. We have 2.3 million households in rental stress with cash flow pressures. We have 488,000 stressed investors, and we have 4.6 million households in financial stress. And that's going to be an issue. Now, of course, one of my expectations is, as we come up to the next election, is we're going to see more support potentially from government, because they want to try and show that they're doing things. But the question is, will it help or will it hinder? And as Cookie Boy makes the point, any news on grants to lure more sheep to the Ponzi? Yeah, I think that's probably what they're going to do. They're going to try and help more people to get in, and also to try and help alleviate the fact that many people are having difficulty. Now, I know that households are in difficulty, and I know that the governments are concerned, but they're concerned for the wrong reasons. They're concerned about trying to get re-elected rather than tackling the root cause issues caused by high migration, caused by bad RBA policy, as I showed earlier on, through the Term Funding Facility, and the other global liquidity plays. And of course, also the fact that the government is wanting to support the construction industry, And unfortunately, that means buying more high-rises, as I discussed the other day with Edwin. Now, if I look at my data in a different fashion, this is now the segment information. You can see here, and I've highlighted just the segment with the most difficult pressures. So young growing families, including first-time buyers, 91%. That's now 286,000 households in mortgage stress. In the rental stress sector, it's touching multicultural establishment. They're the first generation Australians, so people coming in and renting initially. But we can also see there that young affluents, young growing families, mature stable families, and stressed seniors. So it's quite widely spread in terms of rental stress. If you look at the stressed investors, 24% of young affluents having difficulty, 29% of exclusive professionals, and exclusive professionals have more wiggle room. Some of these young affluents have less wiggle room. And if you look overall, you can see that financial stress is highest among young growing families. And that's telling us that 496,000 young growing families across the country are in difficulty. That's really bad news. If we then look at the mortgage stress data, I'll quickly go down this. No change at the top, so it's still Liverpool in New South Wales, postcode 2170, and that's 38,000 households there. Then Campbelltown in New South Wales, 2560, with 29,000. Then we go across to Western Australia and Wanneroo, 6065, with 24,000. Then Toowoomba at 47,000 households and 10,000 there in stress. So 13,000, 11,000, 11,000 and 10,000 in mortgage stress. You can see here that the count of households is pretty high, but the mortgage stress is also pretty much, and in say Campbelltown, pretty much everybody's in difficulty. If you look at Narre Warren in Victoria, they're there too. Then Camden in New South Wales, Donnybrook in Victoria, Tarnit, Berwick, Harkaway, Ballarat, of course, regional area there too, Pakenham, Marsden Park, Queanbeyan, and then Merriwa, Clarkson in WA. Now, the thing about this is a lot of these areas are those high growth corridors, a lot of new properties being built, a lot of homeland packages were bought 2 or 3 years ago. So there is a bit of history here, but it's also touching regional Australia, Toowoomba and Ballarat as well. If I then look at the rental stress, Melbourne, of course, centre of Melbourne, right up the top there, then Toowoomba, then Liverpool, Wentworthville, Southport in Queensland, Tarnit, Point Cook and Derrimut in Victoria, Zetland in New South Wales, Campbelltown, Coomera in Queensland, Mount Druitt, Cranbourne, Blacktown, Ipswich, Highgate Hill and South Brisbane in Queensland, Gosford, Central Coast there, and Fortitude Valley. And you can see here the counts are quite high, 15,000, 14,000, 13,000, down to 8,000 at the Fortitude Valley. If I then look at stressed investors, it's interesting that Western Australia is right at the top there in Sampson, that area, then Toowoomba, then Cranbourne, then Riverstone, then Wentworthville, then Chatswood, then Queanbeyan, Bundaberg, Wyong. A lot of Central Coast stuff, I think, there as well. Southport, Marsfield, Hornsby, and Paradise Point. So they're some of the areas where investors are underwater on a cash flow basis. And some of those are thinking that they may need to sell. And of course, the Cranbourne story is telling us a lot about what's going on across Victoria. A lot of listings for investment properties there at the moment. Finally, financial stress, if you look at it right at the top, 74% of households, 38,000 there, 28,000 in financial stress, 27,000 at Toowoomba, 22,000 in Campbelltown, Tarnit, Derrimut, Cranbourne, Donnybrook, centre of Melbourne, Ballarat, Mount Druitt, Sampson, Wentworthville, Ipswich, Blacktown, Camden, Southport and Wanneroo. So they're your hotspots. And even if you go down to Southport and Wanneroo, you see 15,000 in financial stress there. And more than half, 60% typically. And some of the highest counts there are in Campbelltown. So it's pretty concerning. And finally, let me just tell you about the risk of default. Now, this is my forward projections. And I'm looking, defaults are still quite low. So only 1,000 over the next year in Cranbourne. Mandarin, Western Australia, still up there. That's because of the earlier boom and bust cycle in the West. It takes a long time for people to fall over ultimately. Another WA postcode success. Then Hoppers Crossing, Tarnit, and then Armidale in Western Australia, Donnybrook, Yatala, Toowoomba, Wanneroo, Dermot, Gosford, Bundaberg, Clyde, and then Mount Pleasant. Now, these are not high numbers, but they are going up. And unfortunately, this risk of default is something which will be a precursor potentially to foreclosure. But I want to remind you again, quite a few people are actually selling before they stop making payments. The banks are working with them. They're supporting them, extending mortgages and those sorts of things for a year or so. And then as ASIC said recently, what happens then is that people are still in difficulty and then the banks have to foreclose on them. And Cookie Boy makes the point. Thank you very much for that. Those who question my data, Finder and the RBA have similar numbers in mortgage stress, many households living day to day. And as I say, it depends how you measure it, but there is a level of consistency about the trajectory. And my quantum is because I'm measuring it very early. Some of the others are measuring it somewhat later. And I would make the point that the RBA data in particular could be flawed because they're using securitized data. Securitized data tends to be hand-picked data by definition. Now, with regards to the momentum in house prices, it is worth just looking at what CoreLogic said, because they did say that home values inch higher nationally as growth loses momentum. They make the point there that it does vary, but you can see there that Melbourne was down again, Hobart was down again, Sydney is slowing. Perth is still quite strong, Adelaide quite strong, and Brisbane is still a little higher, but easing. And here are the latest results showing over the month, quarter, and annually, and the median values. And this is quite shocking when you look at the median value in Sydney at $1.18 million. That's ridiculously high. 777,000 in Melbourne. Brisbane higher. It says Brisbane has overtaken Melbourne now. And Adelaide, believe it or not, has overtaken Melbourne. And even Perth has overtaken Melbourne now in terms of the median value. And that's because, of course, the Melbourne story has been decaying for quite some time. But those spreads of reductions are now bubbling out. And you can see there that the regional stories were quite high. But over the last year, the annual rise, very high in Brisbane, 14%, Adelaide, 14%, Perth, 24%, Hobart, a fall of more than 1%, Melbourne, more than 1%. And over the last month, falls in some areas as well. Another way of representing it, you can see here that the story has changed, and look at the combined capitals. So we are seeing a bit of an ease down, and in fact, if you want to look at it another way, this is just another cut of the data. Now, what about what's ahead? Well, in my scenarios, I try to have a look at what may be playing out. None of these scenarios will be right necessarily, things change, but we use the framework driven by our core models, and it's based on from today. And the three scenarios are, the first one, where we have the Goldilocks zone rates stay at 4.35%. They fall later in 2025. Inflation eases with expectations of the RBA. Wages rise a bit faster. No recession. Migration remains strong. The second is a soft landing where you have rates above 4.35%. Inflation falls, but then rises again, stays above target until 2026. No recession, migration falls. So the migration lever is quite a powerful one in terms of house prices. And the third is the nightmare scenario. Now we have higher rates, 4.35% up. Mortgage rates will be 7.25% up and stay high through 25. Inflation stays sticky, unemployment rises, wages growth stalls. We have recession, and then rates get cut, but probably too late. Migration drops below average. So those are the three scenarios I run. I could run others, but those are the three. And if I do that, then what we can now look at is some of the consequences of that. And I remind you that the forward projections of interest rate cuts, according to the markets, have actually changed again. So they are still looking for cuts through 25, but not anything like as aggressive as they were previously. And that is partly because of this move in the 2-year bond rate, as I mentioned earlier on in the show. That's signaling rates higher for longer too. The 2-year rate is a proxy for the cash rate. Hence, the markets are actually now wiring in. And look, the markets are only taking expectations. They're not predictors either. So if we then take that and say, well, what's the outcome? In Victoria, my very best case for Victorian house prices, they're pretty much flat over the next 3 years, actually up 0.9% for houses. And the base case will be a fall, quite a significant fall over 3 years, maybe 19%. And the worst case, if things really fell apart, would be 39%. Now, that downside scenario is maybe unlikely, but not necessarily completely off the table. Units, pretty much the same, falling a little less, and that's true even in the worst case scenario in Victoria. So Victorian prices, I can't see much upside ahead. If I compare Western Australia, though, Western Australia still has significant upside in the best case scenario, maybe 17% over 3 years. On the base case, maybe a small fall. In fact, a rise and then flat and then a fall over 3 years. This is cumulatively 3.2% over 3 years. Base case, a more significant fall. Units, not quite such a strong rise, nor such a strong fall. But you can compare and contrast Victoria with Western Australia. If you then look at New South Wales, well, the best case is there is still an upside, 10% over 3 years, or the base case, 10% fall over 3 years, and the worst case, 29% over 3 years cumulative for houses, and units following along pretty closely, maybe not quite as dramatically falling. If I take Queensland, there is still potential for a rise, 16% over 3 years. That's the best case. Base case, a fall of 3.6%, worst case, a fall of 23%, and units following on. And if I then look at South Australia, you can see there that still significant rises, best case 19%, the base case flat pretty much over the next 3 years, the worst case a fall, and that fall about 20% over 3 years, and the base case for the units following along, not quite falling as much. On the ACT story, very little upside, even in the best case scenario, 3.5% on the best case. ACT is definitely seeing some negativity at the moment. The base case, a fall of 16%, and the worst case, a 36% fall. And you can see units pretty much following along suit, not falling quite as much. And finally, in the NT, very low sample, of course, but there is significant variation between the best case up 18%, the base case down 1.9% over 3 years, and 21% over the worst case scenario over 3 years, and units following along. Now, let's just bear in mind that we can also talk about the individual postcodes. And to do that, we'll be able to look, I think, at some of the more information from my models. But before I get there, let me just show you the way this works, because I always show you this particular postcode in Wollongong. Wollongong, of course, has 18,000 households, 27% are owning outright, 23% are borrowing, and 49.1% are renting. And you can see there that at the moment we've got mortgage stress at 35% and rental stress at 81%, and stressed investors at 30%. As a result of that, you can see there that there is still potential for price rises to go up in the best case scenario for houses. Units a little less, but pretty close, but the base case is down 12 and down 10%. Now, in terms of stress and how that plays out, what types of property? 35% houses, 52% are units. Other types of property includes things like retail, living above retail, that sort of thing. We've got people ratio of 2. Now that is showing you that it's mostly couples and maybe a few solos and families. That varies by place. The vacancy rate, this is based on the survey that was done after the COVID period. So it's probably a bit off, but 9.8%. Net gross investment yield, that's the comparison between the price of the property and the rental that you can theoretically achieve at 3.3%. Net investment yield is minus 0.9% though, so people are losing money on a cash flow basis. And if you look at the average taxable from the ATO is 79,000 versus 84,000 from the census, which gives a disposable monthly income of 5,635. And that translates then to 43.8% of households, 43.8% of disposable income. So that's after tax going on the mortgage, $2,467,000 per month, and 35.4% going on the typical rent at $1,993. Now that's a lot of pain and pressure. So that is the sort of analysis that we do. And we can take the show in a couple of directions now. I can spend some time on the maps, I've got those loaded. But what I'm going to do firstly, because I see that there's quite a lot of questions in the chat relating specifically to the postcode analysis. So I think what we'll do is we will actually do the mapping analysis. And let me just set this up so that we can do that. Where are we? Prices. No, let's try there. Okay, so I am going to switch across to this one. Okay, hopefully you can see that. While I go down and have a look at the chat, I'm going to go up to the top and see where you started, because people asked quite early, I have to say, and I'm very grateful for all those who chipped in with some postcodes. So let's have a look. Okay, 2099 says Matt Caffrey. Yep. So let's put up 2099. Whoops. 1 second. Yeah. So this is DY on the Central Coast. I'm just going to take the chat off so that we don't get too distracted. All right, so this is DY in the Central Coast, 17,000 households in the postcode, 26% own outright, 34% of borrowing, 39% of renting, 29% in mortgage stress, 79% in rental stress, 30% in investor stress. So overall financial stress, so that's the aggregate measure, 57%, more than 9,900 households in difficulty. If I look at the property mix, 39% are houses, 53% are units, and 7% are other types. You can see the people ratio is 2.36, so that includes quite a few families there. The vacancy rate was 6.6% back in census time. The gross investment yield is 3.4, net investment yield underwater minus 0.4%. So that is the combination of the costs of managing and paying for the investment property versus the actual real income that you got from the property. So people, on average, losing money. On the taxable income front, 92,000 from the individual, that's the ATO number, 113 from the household census. Now, when there's a significant variation, that often indicates that more than one income is going to pay the mortgage. The disposable monthly income in this postcode turns out to be around $6,200, and your typical mortgage holder is paying more than half, 52% of their disposable monthly income, that's after tax, $3,240 a month on their mortgage, ooch, and 44.1%, $2,740 a month on the typical rent. Looking at the scenarios, the best case scenario for prices would be a 6% rise cumulatively over 3 years. The base case, a 14% fall. The worst case, a 33.6% fall over 3 years, bearing in mind those scenarios I went through earlier on. And on the units, similar story, not quite as aggressive in terms of fall. And I must tell you that quite a few of the Central Coast postcodes are in grief at the moment. I'm seeing quite a lot of pressure there. Let's go to another one. Paddy asked for postcode 2251. So this is McMaster's Beach on the Central Coast, so another Central Coast story. And I'm afraid that the story is not a lot better on this particular one either. So let's have a look at that. 13,300 households there, 40% own outright, 41% are borrowing, 18% are renting. 51% in mortgage stress, 95% in rental stress. The stressed investors at 16.5% and 43% of households in financial stress. Looking at the property mix, mostly houses, 82%, some units and other types of property there. The people ratio is 2.22, so again, a bit of the higher end, so that includes some families. Vacancy rate was higher, 12.6%. That'll be some holiday accommodation and Airbnb in the area. Gross investment yield is 3.3, and net investment yield is minus 0.6%. And looking at the taxable, 82,000 from the ATO, 89,000 from the census, gives a disposal monthly of around $5,000, with 51.2% or $2,600 going on the typical mortgage payment, and 44.1 or $2,243 going on the typical rent. And you can see there that the stress is driving some pressure on property. So even the best case scenario, growth of 5.5% over 3 years, best case, or fall of 14%, base case, or 33.8% for the worst case for houses. So again, another example where the postcode story is looking a problem. Okay, Lily White, the conspiracy realist, says, can I look at 3 postcodes? Well, I'll certainly start. I'm not sure that I can get to all 3. So 5540. 5540 Port Pirie South. Let me just get rid of that temporarily so you can see all the data. So this is in the Barossa. And there you can see 6734 households, 34% own outright, 33% are borrowing, 32% renting. Mortgage stress only at 20%, rental stress at 79%, stressed investors at 20%, and households in financial stress at 37.2%. Mostly houses, 84%, small number of units and types of property, people ratios just below 2, and the vacancy rate was quite high at 11.6%. Maybe some second homes and maybe Airbnb there too. The gross investment yield is 4.3%. South Australian yields tend to be a little bit higher than those in New South Wales. Net investment yield is underwater, minus 0.3%. Typical taxable income, $66,000 for the individual and $55,000 for the household census, giving a disposal monthly around $3,500, with 32% going on the typical mortgage, 1152, and 25.8%, 922, going on the typical rent. So you can see here, compared to the Central Coast, excuse me, the story here is less pressurized. One of the reasons why we're seeing prices still quite bullish on the best case scenario, up 16%, although the base case, a fall 3.6% over 3 years for houses, and the worst case down 23% over 3 years. Now you also asked for 5608. So that's Y. Ella Stewart, and that's in the Erie Peninsula. 5,900 households, 23% owning outright, 29% borrowing, 47% renting. Mortgage stress much higher, 72%. Renters in rental stress, 63%. Stress investors, 19.6%. And households in financial stress, 55% overall. 40% of houses, 4.2% of units, and other types, 55%. So that's a lot of different types of stuff going on there. People ratio is a bit low, 1.81. 14.4% vacant. That could be some Airbnb and holiday accommodation, possibly. Gross investment yield, 3.9. Net investment yield, positive. First one we've seen, plus 0.2%. Average taxable, 71,000 from the ATO and 50,000 from the census, giving a disposal monthly of 3,476 a month, with a third going on the typical mortgage, 1170, and 24% going on the typical rent. From a scenario perspective, best case scenario, 12% rise over 3 years, base case down 8%, worst case down 27.4%. Units following along as well. And finally, you asked for 5700, Port Augusta. And there, 4,621 households with 31% owning outright, 26% borrowing and 42% renting, 82% in mortgage stress, 82% in rental stress, 59% in financial stress overall, 70% in houses, 8% in units and other types of property at 14%. 1.83 is the people ratio, so it's a bit lower, perhaps some singles and maybe older people there. 18.7% vacant, so again, maybe Airbnb and some second homes too. 3.8% is the gross investment yield, but minus 0.1% is the is net investment yield. And the taxable income, 69 versus 62,000. Disposal monthly, 4,322, with 30% going on the typical mortgage, 1,300, and 23.1%, 9,770 going on the typical rent. So there we go. Okay, the next one, Adrian asked, can I look at 2153? Sure can. That's the Balcombe Hills in Sydney. And there you can see 21,800 households, with a third owning outright, 44% of borrowing and 21% of renting. Mortgage stress, 28%. The rental stress, 90%. Stressed investors, 21.3%. And households in financial stress, 40.3%. 75% in houses, 13% are units and 11% other types of property, 2.79. So this is a lot higher. That's more households. And with kids, perhaps. 5.5% vacancy rate, a bit lower than we've seen previously. 3.4% gross investment yield. Net investment yield is minus 0.6%. Average taxable, 94,000. Household census, 129,000. So multiple incomes going to support the mortgage, giving a disposal monthly of around $7,290 a month, with 45.4% going on the typical mortgage at $3,311 and 36.9% or $2,691 going on the typical rent. On the scenario front, 8.7% over the next 3 years, best case scenario, down 11% base case, down 31.4% the worst case, units following on. So we'll look and see what else we can find in terms of other requests. Okay, here we go. 4109 is the next one. 4109. Hongsta. 4109 is Sunnybank Hills, and that includes Robertson and McGregor. 12,800 households, 37% owning outright, 27% borrowing, 35% renting. 1/3 in mortgage stress, 83% in rental stress, and 21% in investor stress. Financial stress overall, 44%. 83% of houses, small number of units and other types of property. People ratio is 2.75, so that's quite a few families with kids. 7.2% is the vacancy rate. The gross investment yield is 4.3, and the net investment yield is positive 0.2. Once again, you'll see that the investment yields are slightly higher in Queensland than across Melbourne or Sydney. Average taxable 69, household census 87, gives a disposal monthly of $5,632 a month, with 40% going on the typical mortgage, $2.288 a month, and 36% going on the typical rent, $2,044 a month. On the scenario front, best case up 13%, base case down 6.6%, and the worst case down 26.1% for houses. Units following on. And I will make the point that we are seeing a bit of a turn in the Queensland market, particularly actually in some of the outer suburban areas. Max Freedom asks for 6065. Thanks for that. 6065. Tapping. Wanneroo, one of my favourite postcodes. One of the ones that comes up quite often in my headlines anyway. So look at the disposable story here with, sorry, look at these count first, 24,000, 22% earning outright, 59% borrowing, 17.9% renting, 76% in mortgage stress, 82% in rental stress, some stressed investors too, giving an overall financial stress measure of 62%. 92% are houses, often crammed on quite small plots, of course, a small number of units and other types there as well. People ratio is 2.73, so again, that's some families, not just individuals. Vacancy rate was just 4.6%. 3.7% gross investment yield. Net investment yield is minus 0.7%, so once again, investors losing money. Average taxable, 78,000. Household census at 110,000, so multiple incomes, paying the mortgage, giving the disposal monthly of $6,800 a month with 35.1% or $2,400 on the typical mortgage and 29.2, 1993 going on the typical rent. On a scenario front, best case up about 8% over 3 years, base case down 11%, and the worst case down 31% over 3 years. And I'm seeing some of those outer suburban areas where there's been a lot of growth and a lot of development, certainly driving property prices sideways rather than up at the moment for some people. Now let's look at 4615. Thanks to Alan for that one. 4615 is Brisbane and Moreton and includes quite a few areas. Narango, Maidenwell, and Whyalla as well. You can see this long list of... So the way I do this is to pick up a one name, but then actually give the full list there of suburbs. And 3,000 households there with 48% owning outright, 28% borrowing, 22% of renting, 36% in mortgage stress, 86% in rental stress, some stressed investors, 23%, overall financial stress, 34%. 92% houses, 3.7% units, small number of other types of property there too. 1.93 to the people ratio, so a little lower than some we've seen. So perhaps some solo owners, occupiers as well. And we see vacancy rates at 13.3%, so that could also be some second homes and Airbnb. Gross investment yield 4.4, net investment yield is minus 0.2%. So this is another example where we're actually seeing in Queensland the investment yield going negative. Average taxable 65,000, household census 47,000, giving a disposal monthly of 3,000. 39.4%, 1200 is the average monthly mortgage payment, and 36.8%, 1,121 on the rent. On the scenario front, 12.7% in the best case scenario over 3 years, down 7.8% for the base case and down 27.3% worst case. Okay, Hexamigo, thank you very much for the super chat. Greatly appreciated. And you've asked for 5501. Thank you very much for the super chat. 5501 is 2 wells in Outer Adelaide, one of the smaller postcodes here. 2,900 households with 27% owning outright, but 62% are borrowing, 9.8% are renting. A lot of new development, we would suggest, in that area. 37% in mortgage stress, pretty much everybody in rental stress. This is plus or minus a couple of percent, so it might not be everybody, but quite a lot of people. 8.9% stressed investors, 35% financial stress. Pretty much all houses. So there could well be a lot of homeland packages going on, I suspect, in the outer Adelaide area there. We see that the people ratio is 2.41, so that includes quite a few households with families. 11.3% vacancy rate. That could be some being built but not yet occupied, or maybe even second homes or Airbnb, I'm not sure. 4.3% gross investment yield. Net investment yield is negative, minus 0.1%. And the taxable is 68 from the ATO, 88 from the household census, so multiple incomes go on the mortgage. Average monthly disposable, about 5,300, with 35% going on the typical mortgage at 1,908 and 26.8%, 1,446, going on the typical rent. On a scenario front, best case up 13% over 3 years, base case down 6.9%, falls each year, cumulatively 6.9%, and the worst case scenario down 27%, and units for what it's worth following on. And once again, thank you for the super chat. Steve has asked for 4053. Thank you, Steve, for that. 4053 is McDowell in the Moreton Bay area. And we see there that 19,000 households, 25% owning outright, 38% are borrowing, and 36% are renting. 40% are in mortgage stress, 88% are in rental stress. We have 20% in stressed investors and 52% in financial stress overall. And let me just show you that the mix of properties, 76% houses, 11% units, 12.13% of the types of property. 2.38 is the people ratio, so again on the high side, so that's families. 5.6% the vacancy rate, and gross investment yield is 4.4, net investment yield is positive 0.4. Average taxable 83,000, the household census 111,000, giving again the clue that we're getting multiple incomes on those mortgages. Disposal monthly 6958, with 35% going on the typical mortgage and 29% going on the typical rent. 2476 versus 2044. Scenarios say best case 12.5% over 3 years, base case down 8%, and the worst case down 27.9%. Units following on. And 5084, Kilburn, half of our suburbs is knocked down to be rebuilt. Thank you for the super chat. Let's have a look at that one. 5084. Whether you can hear the rain, but we're having a thunderstorm here at the moment, so it's quite noisy outside. This is Kilburn and Blair Athol in the Port Adelaide area, and a lot of stuff going on there. I think 4,000 households, 19% owning outright, 28% borrowing, and 51.9% are renting. 82% are in mortgage stress, 67% in rental stress, 25% in stressed investor land, 63% in financial stress overall, 61% houses, some units and other types of property going on there as well. People ratios on the higher side, so families, I suspect. 8.4% vacancy rate, 3.9% gross investment yield, minus 0.7% net investment yield. Average taxable 57,000 versus 68,000, giving a disposal monthly of $4,742 a month on average after tax. 38.4% or 1820 typical mortgage payment, and 30.5% 1466 typical rent payment. And looking at the scenarios, up 9.8% over 3 years, best case. Base case down 10.5%, worst case down 30.1%. And thank you very much, Helena, for your Super Chat contribution. You're first, so I really appreciate it. Drew asks for postcode 3461. Okay, this is in the Drummond area, Hepburn Springs, Musk, in the Heathcote Castlemaine area around Bendigo. Now, let me just make the point that this one is a low count. When we get the low count indicator, it means that the overall sampling might be a bit suspect here, because we use a 0.5% sample, which means we might get a small number of readings for this one when we gross it up. Nevertheless, we have 50% owning outright, 30% borrowing, and 10% renting. We have 75% in mortgage stress and 100% in rental stress, maybe slightly inaccurate. 40% in financial stress overall. Mostly houses. People ratio is low, 1.56. 29% of vacant, so could be possibly some second homes or Airbnb or something else going on there. Gross investment yields at 3. Net investment yield is minus 0.9. Average taxable 79 versus 71 for the household census, giving a disposal monthly around 4,700, with 38.6% going on the typical mortgage at 1820 and 32.3% at 1520 on the typical rent. And looking at the scenarios, well, because of this high stress story, we're forecasting that from a scenario perspective, even in the best case, there could be falls and significant falls. Again, take that with a pinch of salt. This is a very low count. these readings may be a little bit off. Boss one said 4053 is acreage always been expensive. Let's look at 4053. This is McDowell. Okay, so this is Brookside, Everton Park, Stafford. 19,179 households with 25% owning outright, 38% borrowing and 36% are renting. 4% in mortgage stress, 88% in rental stress, some stressed investors too, and 52% in financial stress overall. 76% of houses, some units and other types of property. The 2.38 people ratio suggests some with families, 5.6% vacancy rate, 4.4% gross investment yield. Net investment yield is 0.4% positive. 83% from the ATO, 111,000 from the census data on taxable income, giving a disposal monthly around 6958, with 35.6% or 2476 going on the typical mortgage repayment each month, and 29.4 or $2,044 a month going on typical rent. Scenarios would suggest best case up 12% over 3 years, base case a fall of 8%. Worst case, a fall of 27% over 3 years, and units following on. You're welcome, Steve. Glad I could help. David Booth asked about 5092. My council rates have gone up ridiculous amounts, over 35%. Yes, council rates, electricity, it's all going in the same direction, unfortunately, David. And that's why I measure it on a gross cost basis. In other words, all the expenditure rather than just on the mortgage components alone. Okay, so this is Modbury North in the Tea Tree Gully area of Adelaide. And there, 7,400 households with 34% owning outright, 43% borrowing, it's high, 22.6% renting. Mortgage stress 46%, rental stress 71%, stressed investors 11%, and households in financial stress 39%. 87% of houses, small number of units, other types of property. The people ratio is higher, so 2.39, so that'll include some families. 4.5% vacancy rate with 4.3% gross investment yield and minus 0.2% net investment yield. 64,000 taxable from the ATO. 77,000 from the census, giving a disposal monthly of just under 5,000. 36%, 1,756, going on the typical mortgage, and 34%, 1,670 on the typical rent, and 15% growth over 3 years on the scenario basis, best case, fall of 4.9% over 3 years, base case, and 24.7% down on the worst case scenario. So there you are. And I make the point, I think, that some of the Adelaide stories with recent prices are putting quite a lot of pressure on people in Adelaide because they're chasing higher mortgages. Here's another one, 4505. So let's put that one in. Okay, so 4505 is in the Brisbane and Moreton Bay district and Burpengary. 9,621 households with 29% owning outright, 43% borrowing, 26.9% are renting. Stress, 82% for mortgages, 90% for rental stress, 14% for investors, and 62% for financial stress. We're seeing 86% in houses, small number of units and types of property. People ratio is 2.61, so that includes some families. Vacancy rate is 3.8%. Gross investment yield is 4.3. Net investment yield positive 0.5. Average taxable 69,000. Household census 91,000. So again, a big clue there. Multiple incomes going to pay the mortgage. Average monthly income is around 5,500 disposable after tax, with 39% going on the typical mortgage at 2,180, or 32%, 1,800 going on the typical rent. Looking at the scenarios, best case up 7.6% over 3 years, base case down 12.5%, the worst case down 32.7%. So there we go. And I think we're up to date. So if I've missed anybody, apologies. Just go back and check. There's so much going on in the chat there. We've had lots of chats, and so sometimes it's hard to keep up. Okay, I think I'm up to date, so that's good. So let me just come back to the main screen. So what I've now got is the chance to share with you some of the charts that I also create. And those charts, of course, are very much about looking at the story with regard to the mapping. Just get my mapping. There we go. Let's get that up to show you. Right, let me show you the mapping. I'm going to start, I think, with the standard mortgage stress analysis first, and then perhaps we'll go on from there. So let's put this on screen. So this is the count of households in mortgage stress. I've started in Sydney, and you can see here it's color-coded with the blue the lowest and the oranges and reds the highest. And as we pull out, you can see there that the story starts to morph, and you begin to see the darker colors coming in as we come in to the west. The term I've used before is the ring of fire, and I think that's still quite a good term, insofar that we're seeing Liverpool coming in and registering, Camden, and then up to the north beyond Blacktown. And you can see there that across, remember this is numbers of households in difficulty, mortgage stress. You can see here that it is very much to the west in this area here where a lot is going on. But I'd also make the point that in and among this, there are some areas where the blues are still there, like in Fairfield, for example. And closer into the city, not so much in terms of numbers. Now, if I've got time, I'll show you also the percentage one, because the percentage one tells a very different story. So bear that in mind as I go through Melbourne. So this is now the centre of Melbourne. As I pull out, you can see once again a similar story with the inner suburban areas in and around Melbourne not doing so bad. As you go out, you start to move into the yellows. As you pull out further, then the darker colours come in with Wyndham, 3029, of course, showing up there. It's Point Cook. And then to the east, 3086, 3810, and around Casey, to the north as well, and then even regional areas in Ballarat. So once again, you can see these outer suburban areas from Frankston round, and also in this area around here and to the north, all very much centres of gravity for mortgage stress. Now, if I go to Perth, and if it looks at the centre of Perth, again, it's a similar story close in. Not a lot going on, a lot of blues, a lot of low counts, close in. But as you pull out, you start to see Churchlands and Woodlands in 6018, having some significant pressures there. Stress is maybe not as high uniformly spread, but it is actually showing in some of these high growth corridors. Wanneroo, of course, is one of those. 6065 is one that really shows up. 6164, 6163 towards Fremantle as well. And as we pull out to the north and to the south, we do see some pressure points. So it's not uniformly spread, but here in this area here, high growth corridors, a lot of new development. It's not perhaps too surprising. And I will just do Brisbane, because Brisbane, again, is another story. Close in, not too much from a count point of view. As you pull out, you start to see 4152 is one there, Camp Hill and Carina. And then as we pull out further, you can see that there are other areas popping up as well. To the north, 4034. Ipswich, of course, 4305. And other ones, 4300. And if we pull out towards the Gold Coast as well, you can see there that nothing much to see some counts, but not dramatically high. But here we have Toowoomba, of course, 4350, which really stands out. Now, that was looking at it from the point of view of the count. We can also look at it a different way. And that way is to look at it in percentage terms. Now, this is now the percentage of households in stress in a particular postcode. And as I said before, there's two different ways to look at this. The percentage story actually tells us something quite different. And so we start in Sydney, and you can see here that the percentage of households in stress, despite the fact that counts are a lot lower, are actually showing much more in the east. North Bondi, down through Bondi, Bronte, Randwick, St Peters, Tempe, Enfield, Strathfield. To the north, up towards North Sydney, Ottoman, Hunters Hill, Manly. So this is a really interesting observation. Because the population density is so much lower, these don't show up as dramatically in my main analysis. But when you start looking at percentages, you can see that there are problems in and around quite a few areas. Lane Cove, Northmead, Botany. And then, of course, the same high counts are also high percentages. So they show across Campbelltown, Liverpool, and even Fairfield on a percentage basis is showing. Remember, I said that Fairfield didn't have too much to write home about? Well, that's because it's a small population density. So this is an alternative view, and this is quite important. So there are stories amongst more affluent households, as you saw from my own analysis. And in some areas, we are seeing the story quite significantly bubbling up. Now, let's go to 3,000. I will do Adelaide. I saw that comment come in the chat there. I will do Adelaide as well. So this is the percentage story. And again, it's a very different story from what you might think from the other analysis. Again, population density in some areas quite a lot lower. So even places like Windsor is showing up, and Kew East, Moonee Ponds, and Essendon. So these are areas where the population density is lower, but the percentage of households with mortgage stress problems is actually quite high. And as you pull out down towards Bayside, and you can see there that there are issues as well, even into the Yarra Ranges and Knox. As we pull out, you can see here that out in the outer suburban greater Geelong area, again, we have significant pressures. And of course, Ballarat still shows. So the percentage story is rather different from the story that you get when you just look at the overall counts. Let's do the 4,000 series. So this is Adelaide. Sorry, this is Brisbane. Okay, I'll do 5,000 seconds. This is Brisbane. So again, it's a similar story. Closer in, the population density may be lower in some areas, but nevertheless, there are some pressure points. It's not so extreme, but as you go out to, for example, Wakerley and places like that, 4155, 4156, even down towards Logan, 4127, areas of Ipswich, of course, and then further out as well. So it does change the story. And in fact, as you look down towards the Gold Coast, you can see there that there are some areas back behind the Gold Coast in particular in some difficulty. And in fact, if you go up the other side of Moreton Bay, you can also see that there are some significant pressure points, even up around the Sunshine Coast and higher than that. So it's interesting to see this as an alternative way of looking at the data. If I then go to 5,000, I've now got there. 5,000, you can see here on a percentage basis, there are households in and around Adelaide that are in some difficulty. So Richmond, for example, Plympton, and then Felixstowe, Broadview, and then to the north and to the south of Adelaide too. So there is a very significant story here, which is often not told. That is because the total count is a lot lower. The population density is quite a lot lower. And, if I just go back to the other chart, and I'll just do Adelaide. on the other chart too. So this is Adelaide now looking at the count of households, and you can see that on an absolute basis, Adelaide doesn't show anything like as much. And so there's a very important message here that depending on how you look at this data, you can read it different ways. The reason that this is so significant is that the population density overall is a lot lower, but nevertheless, despite the lower population density, the percentage story tells a very different story. Go back to the percentage data again, and I'll just go to 6,000. Now this is the Western Australian story. So do we see the same again? Not so much. So you can see that WA is still on a percentage basis in the centre, not doing too bad. But as you pull out, you start to see the percentage rising. And again, to the north and to the south, South Perth, round Fremantle, and then up towards Wanneroo and above, and also inland as well. So again, the percentage story does tell you something quite significant, interesting. And in fact, as you pull out, you can see there that to the south, south of Rockingham in particular, high percentages. Okay, so there you go. That's a little bit of the mapping information. Now let's just go back to the chat and see what's been going on. Helena made the point, so much growth in price, it's crazy, but with all the building that's going to happen next 6 months, I'm split on whether to hold or sell. Yeah, I think it's quite difficult. The question is, if you're owning property for investment purposes rather than for owner-occupied purposes, if you're owning it somewhere to live, then you might want to ride it up and ride it down, because having somewhere to live is the main thing. For investment purposes, one of the things that we're seeing in Melbourne is that quite a few people have now decided that, in fact, prices are going to slide. And so what they're doing is actually looking to get shot and yield some of the growth from that equity that was created. Remember that, in a way, this equity is artificial. I said at the start of the show, it's been created by all this pumping and dumping of liquidity, both from the Reserve Bank and from government policy. That chased houses a lot higher. And then, of course, we had higher migration, which also added to demand as well. And we're not building much. So all of those factors are in play. But whether we can actually now see prices continuing to go higher goes right back to, what do you think about those scenarios? Do you think we're going to see inflation under control? Will the RBA be able to bring those rates down? Or do you think they're going to actually have to keep them higher for longer? And of course, Michelle Bullock the other day said, probably not this year, maybe next year, but bond rates, as I highlighted earlier on, are suggesting maybe higher for longer. So it's a tricky one. If you're an investor, some investors are now saying time to crystallize. And remember, if you're an investor and you actually got a mortgage, have you done the cash flow on the mortgage payments? Because most investors seem to look at just gross investment yield, which is the price versus the rental return. What you should be looking at is net investment yield, which is after all the costs. And with all the costs of maintaining the property and particularly keeping it up to scratch if the regulations are tightened like they were in Melbourne, that's costing people a lot. Costs of the mortgage and cost of management of the property are higher. And when you do the sums, quite often investors are underwater. And of course, you can get 4%, 5% in term deposits at the moment. So the investment story, or indeed invest in stocks and shares, has done very well. So for many property investors, they're shocked to discover that there is little cash flow value. And if there's no capital appreciation, then the best thing is to get out and release what you have. So that's my take on it. Okay. What else have we got in the chat? All right. Here's one. Coomera, please. 4209. Sure, we can do that. Let's transition back and put the slide on. And I can put the data in for you. I need an AI to do this. 4209, there you go, 4209. Okay, this is in the Upper Coomera. And you can see here that we have 24,300 households. 11% earning outright, 40% are borrowing, 48% are renting, 32% in mortgage stress, 83% in rental stress, 25% in investor stress, and households in financial stress, 60%. You can see here that we have 79% of houses, small number of units, other types of property. We have a 2.9% one ratio. That's a lot of families. Vacancy rate's quite low at 4.2%. Gross investment yield is 4.4. Net investment yield is positive 0.4%. Average taxable 69,000. Household census 100,000. Again, highlighting multiple incomes going on the mortgage. The disposal month is around $6,200 with 37% going on the typical mortgage, 35% going on the typical rent. That's 2,340 for the mortgage, 2,217 for the typical rent. And looking at the scenarios, 13.2% rise over 3 years, best case. Flat or falling base case, down 7.1% over 3 years. Worst case, down 27% over 3 years for houses. David asks, one more if you can. 5117. We're nearly running out of time, so you might be the last. Brad also put one in. I'll try to get to you, Brad, as well. 5117. Okay, 5117 is Angel Vale. Some lovely names around. It's a low count, so just be careful with this data. It may not be very accurate. 1353 households with 25% earning outright, 69% borrowing, 5.3% renting, 83% in mortgage stress, no rental stress to speak of, 97% of houses, 2.91, so again, quite a mature suburb, possibly with families, 3.7% gross investment yield. Net investment yield is minus 1%. Low sample, so it might not be totally accurate. Average taxable, 72,000. Household census, 116,000. Multiple incomes going on the mortgage. And if you can look here, disposal monthly is 7,362 with 29% going on the typical mortgage, 2,192, and 23.7%, 1,745 going on the typical rent. Scenarios, best case up 21%, base case flat, worst case down 18.9% over 3 years. Brad asked for 3825. Thank you, Brad. And we do look at the Melbourne ones, of course, quite often. 9268 households with 39% owning outright, a third borrowing, 27% renting. Mortgage stress 63%, rental stress 100%. Stressed investors at 15%, overall financial stress 52%, 86% of houses, some units and types of property. The people ratio is 1.96, a bit lower, 10.7% possibly some Airbnb and second homes, 3.5% gross investment. Net investment yield is 0, minus 0.6%. Taxable average 69,000, household census 55,000, giving a disposal monthly of 3,674. 35% going on the typical mortgage at 1,300 and 29.2% going on the typical rent at 1,072. On the scenarios, I'm afraid that even the best case of fall, worst case, a significant fall, and the worst case of all is at 47% if things go really badly. Full throttle, 3029, another Melbourne one. 3020. Sunshine West. And we have 16124, 34% earning outright, 30% borrowing, 34% renting, with 30% in mortgage stress, 81% in rental stress, 16% in stressed investors, 41% in financial stress, 76% in houses, units, 7.2%. People ratio is 2.49, so again, families with kids, 8.9% vacant, 3.2% gross investment yield, minus 1.1% net investment yield. I think that's the worst yield we've seen. Average taxable, 63% versus 74% on the census, giving a disposal monthly of 4,823 with 43% going on typical mortgage at just over $2,000 and 35%, 1,694 going on the typical rent. Scenarios, even in the best case, a fall. Base case, a more significant fall. And the worst case, a very significant fall. George says, I feel this chat has 100% mortgage stress. I'm saying rental stress, a special spoke ceremony. Thank you. Yes. These are not predictions. I will make this point again. These are not predictions. These are scenarios based on what's going on. David says, have a great rest of the week. Thank you very much. Ian, last one. This is the last one I'm going to do. 303,770. Let's put the slide back up. This is the last one tonight. Low count area, I'm afraid. So, since in Coldstream and Victoria in the Yarra ranges, 11660, very low count. 36% own outright, 52% are borrowing, 11% are renting. Stress is pretty low at 22%. Mostly houses, mostly older people with houses. And I'll to make the point that the vacancy rate was 4.4. Gross investment 3.2, net investment yield at 0.2. And the taxable 114, 104, giving a disposable monthly of just over 5,900, with 39% going on the typical mortgage and 30% on typical rent, 2,340 versus 1,794. On the scenario front, 12.3% best case over 3 years, base case fall of 7.9%, worst case down 27% over 3 years. And there you go. That's the story there. So we're coming to the end of the show. Jason, really appreciate your super chat. Thank you very much. Yes, please do like and subscribe if you haven't done so. Thank you very much for all the super chats tonight. Really appreciated them all. And Ian, you're very welcome. George says, until the next time, unless the census gets us. Yeah, well, we hope they won't. That debate is going, I think, at the moment with regard to the Freedom of Information Bill, worryingly. So let's hope that they're not successful in pushing it forward. A lot of shenanigans going on under the hood, I think. Now, as I come to the end of the show, let me just make a couple of points I always do. If households are feeling financial pressure, it's important to do some cash flow analysis and understand where you are, money in, money out. Many people don't do that. They should do that. APRA has some guides on their Smart Money website, which is quite a good source of cash flow format data. And then once you've got that, prioritize and check. If you've got a mortgage, it's worth checking back with your lender. They do have an obligation to try and assist, and quite often they will try and encourage you to refinance your mortgage or extend the term or go interest only. That can help if it's a temporary problem, but if it's a more permanent problem, it just kicks the problem down the road. I don't think it's going to drop anytime soon. So it's down to household managing their finances better. If you've got loans with high interest rates on them, pay them off first. I'm afraid that buy now, pay later doesn't help, can hinder, and getting more loans can help hardly at all, really. And piling more on credit cards doesn't help either. So there's a problem. Understand your cash flows is the first point. Now, if you have a debt problem, talk to somebody who knows what they're talking about. And I recommend the debt helpline. 1-800-007-007. This is the government-backed helpline. They're very busy, of course. There's so many people in difficulty, but talk to them if you need some help. And the other source of information, which I find quite helpful, is AFCA. There's a statement of financial position available on the AFCA website where you can put in what you earn, what you owe, your living expenses, and basically what you own. It's a form that you can then create as a PDF and use that to take it to a financial advisor, take it to the bank, or indeed talk about it with it to the financial counsellor. So that's a very good tool. It's the best I've seen. And as Down Under Drover puts it, live within your means. Of course, that's the idea, but it's hard if you haven't been able to. The truth is that living within your means is the only way forward. And mortgages are there and appropriate for some people, but the amount of mortgages that many people are being offered today are shamefully high. With the high interest rates, people are going to get into difficulty. And so given the fact that we've got this sort of precarious situation with house prices in some areas and the high interest rates, be conservative is what I would say. And, remember the old adage of 2 to 3 times income was a good measure. Well, people are getting 5, 6, 7, 8 times income at the moment. That's unsustainable. Now, just in terms of other information that I want to share before I go, if you are interested in supporting what we do have a Patreon program. And the Patreon program means that you can subscribe regularly to support us. They really do appreciate those who use that mechanism, because it just keeps us head above water from a cash flow perspective with the show. Also, if you want to get the detailed information, you can subscribe for $50 a month, and you can join to get the monthly stress data. A bit like what I showed you, it contains all 2,000 plus households and postcodes, I should say, and all the household information. That's available, and it's updated every month, sent out after I've done the show here. So for those on the program, I'll be sending it out in a couple of days' time. So that's the story there, and I would remind you again that you can, of course, support us other ways too. If you want to find out more about that, go to the blog, DFA blog. The details are there. You can subscribe to the blog also. You can get information about the DFA one-to-one program and other things too. We also do have a PayPal. You can subscribe via PayPal, sort of via PayPal as well, if you'd like to do that. And on the website, you can see we also even do Bitcoin, if that's something which is of interest to you. Anyway, I want to say thank you very much for spending some time this Tuesday evening. I think this was a very important show because there's a lot of pressure out there, and I want to try and be a counter-spruiker to some of the mainstream media who are pushing house prices are going to go through the roof when rates are cut. Buy now. The banks are trying to actually squeeze APRA to cut the lending ratios. And the RBA, of course, is saying not much to see here, although they do actually admit that more people are actually in difficulty than previously and defaults are rising. So I think it comes back to personal responsibility and taking ownership of your finances. I would close with this thought. In my surveys, less than half of households manage their finances using any sort of cash flow management techniques and just sort of hope it'll be right at the end of the month. I don't think hope is a strategy. So my belief is that managing cash flow, managing your finances is a good first step to making sure that you don't tip over into this stressful environment. Once you're in, it's much harder to get out. And unfortunately, more and more households in my surveys are in a difficult moment. So we'll be back next month with another update. I'll be doing these shows regularly through this sort of crisis time, and make sure that you check in for that. I will tell you that next week, Robbie Barwick is on, and we're going to talk about some of the broader issues and also touch again on the misinformation bill. Week after that, I have Leith Van Onselen coming on, and we'll be chatting about his thoughts about what's going on and, of course, migration as well. So those two shows will be, I think, very worthwhile as well. And meantime, if you'd like to check out my daily shows, they're posted daily, of course, recorded and then posted daily. Check that out. There'll be another one tomorrow. And meantime, I want to say thank you very much for staying with us through the stream. We had a good number on tonight. Really appreciate it. And thanks for all the super chats. Take care. Have a good week. And of course, before I go, I just need to show you the doggies. They've hardly moved. So they're still asleep, ready for lunch and the rest of the day. So that will be the next thing that I'll be doing now. This is Martin North from Digital Finance Analytics saying thanks very much for spending some time with us this evening. Take care. We'll see you next week. Cheerio.